This program proudly brought to you by IPO Wealth for the sophisticated investor.
Hello and welcome to Money Talks, where our goal is to make you richer. Since the end of the GFC market crash, the S&P 500 index of the top US companies has gone up about 230% before dividends, while our S&P ASX 200 index is up about 66%. On tonight's show, we'll work out why our stock market has performed so badly and if circumstances are set to change. And we're doing this with CMC Markets Chief Market Strategist Michael McCarthy and Tribeca Investments Partners June Bay Liu. And of course, later on, my regular stock picker, Bell Direct's Julia Lee, will join us. But let's get straight to it. Now, Michael, let's kick off with you first. I know it's been a long time since the GFC, but our market has perennially performed badly. Why?
Well, perform badly is one way to put it. Yes, it's certainly underperformed, Peter,
Yeah,
but
true.
the reality is it's got a very different composition to most other markets. The most directly comparable would be the Toronto 60, I would argue.
Gee, very few people know that, but now I do. I'm glad. Go on. All right.
But the reason is the composition, and we simply don't have a presence in information technology that other markets do. In the S&P 500, tech stocks make up around 1/5 or 20% of the value of the index. Here, it's about 1 to 2%, depending on what day it is.
And I guess financials must be pretty heavy in Toronto because we're, what, 33% financials? Huh?
Well, absolutely. They're very heavily weighted there, and they're heavily weighted towards resource stocks, which is our other major exposure.
And I guess, Michael, when you put it together, 66% over 10 years, that's still 6.6% per annum capital gain. Throw in the dividends, and there's your 10%.
Well, that's right.
Yeah.
So
we should stop winning.
There have been returns. Well, I've made that call many times over the last year, Peter. I'm not getting much traction with it, but I hope you do.
Okay. So, June Bay, you know, obviously there have been three big developments. One was the end of the mining boom. That didn't help. And then we also had the house price boom, and that's coming off the boil as well. And we've also lost a hell of a lot of prime ministers in Canberra. Hasn't been great for leadership. But is there an underlying problem with the Australian stock market at the moment?
Look, in terms of problem, look, I actually think our economy is, it's really our economy that's really driving it low at the moment. That's why we're underperforming at this point. But it's really investors' confidence at this point. I think, or even going forward in the next 6 months, what's going to drive our stock market's outperformance, because our market tend to be leveraged towards the risk on, you know, so when China does well, when resource stock does well, and so are the risk appetite for our market and for our currency, for that matter. And I think at this point, it's just lack of confidence, given that China is growing a little bit slower than expected, and, you know, US coming off the boil a little bit, or that trade war uncertainty. So investors just a little bit shy away from it.
And you've been nice enough not to bring up the Royal Commission, but that really has held back our market, hasn't it?
Oh, absolutely. That has really put quite a lot of pressure on sectors such as financials, for example, the banks, for example. And that's very market specific, because if you look at the global banks, barring the last couple of months, they actually performed quite well given the yield curve, whereas our banks hasn't done well because the Royal Commission and the sort of, you know, issues that they have uncovered, and the slowing credit growth going forward, and of course what that means for our economy.
Right, so Michael, the Royal Commission, has that really had a big impact on where bank share prices should be? And secondly, the government seems to be interfering in other sectors as well, which I figure isn't great for the economy as well.
Well, and I draw that distinction, Peter. Let's be frank. If the banks hadn't been involved in some poor behaviour when it came to their customers, they wouldn't be facing the problems they're facing now. Yes, right. So while the Royal Commission has been the spur for that, the reality is, and particularly where we get cases where boards have deliberately misled customers and the regulator, that's bad news for everybody. We've relied on self-regulation in the financial sector for a long time. So there's no doubt, though, that over the course of the Royal Commission, we've seen a significant fall in the value. In fact, at its peak, the financial sector made up almost half the value of the exchange. So to be down at 1/3, you can see there's been a major contraction in value in that sector, and a lot of that has to do with the Royal Commission. But in other areas, and in particularly the energy sector, I would argue these companies have been doing what they can in a very difficult environment. And one of the worst things you can do when you're playing any game is to see the goalposts not just shifting, they're moving from the sideline to the try line to the...
Well, the government's taking them home.
They get packed up, the lights get turned off.
Yep.
It's been amazing what they've had to deal with. And a lot of the charges levelled at the energy sector, I think, are grossly unfair. It's a political hot potato because energy prices affect us all, but the blame's been sheeting home in the wrong direction here, Peter. And I'd actually now welcome a Royal Commission there because they've been tarred by association, and the reality is I think they'll come out of it a lot better looking than a lot of people understand.
Okay, also aged care has been slugged as well. Have you been caught out by a government change of policy when it comes to like a company that you thought looked okay and all of a sudden the government went after it?
Look, I think energy sector is that space, really. You know, you look at the companies such as Origin and the like. Company looked great, got a cost out, and have a good, back then, the good oil price support. And, you know, their government came in and said, hang on, you know, we're going to regulate pricing. And we will have a Royal Commission and the like to look into it. What does that mean for the company? It's very hard to put a proper valuation onto it because you don't know what the ultimate value will be you know, what the renewables will cost and the like. So it's much more difficult. Aged care is interesting. You know, the sector is actually sitting with a lot of property value. You know, of course, you know, slowing housing prices is going to put pressure on, you know, what sort of bond value they're going to get. But the company is sitting very cheap relative to the property valuation they should be trading on. But the thing is, no one is going to step in ahead of this Royal Commission because no one wanted to step in ahead of the banks.
And uncertainty is just poison to stock markets, as we've seen with Donald Trump and the interest rates in the US, throw all these curveballs in. The market is dealing with a lot of curveballs, isn't it?
Oh, absolutely. Yeah, we've talked about the domestic risks, just the regulatory risks. There are other domestic risks, and then you've got the global risks. So, yeah, and that's fair enough. After an event like the GFC, investors remain very focused on the risk. I'd argue we've underpriced the market for a long time for that reason, but I can understand why it's happening. Okay,
well, one final question, and it has to be quick on this one. Are you confident that the Aussie economy will be okay in 2019, Michael?
I am, Peter. The hard numbers support that view at the moment. I understand. We're having an argument about what's happening in 2020. Yeah. Right? And that's subject to a lot of honest disagreement.
And Junbo?
I'm a little bit more pessimistic on that. I think we'll be okay, but the risk is brewing in terms of the housing front.
Okay, right. So we're coming back after the break. Julia Lee will come on and share with us her hot stock for the week. And then I'll keep her on and we'll talk about the stocks that these guys do like, given the fact that we've been living through a sell-off in recent times. Welcome back. Consumer staples are seen as an essential spending area, which isn't swayed all that much by good or bad economic times. Julia Lee from Bell Direct joins us to shine her spotlight on this defensive sector, which has done pretty well, hasn't it, lately, Julia?
It is. I thought it was a good time to talk about consumer staples, given the volatility in the market. And generally, during times like this, we do tend to see consumer staples outperforming, which we have seen. So it's been a tough year for the ASX 200, down 7%, and the consumer staples. Including
dividends, or
that's not including dividends.
Okay, so if we take dividends off,
down about 3%.
Yeah, that's right. Yeah, I'm the optimist, but go on.
So if we take the accumulation index down around about 3%, whereas consumer staples is flat, and if you included the dividends, it'd be up about 2.5%. So it has been a bit of a shelter from the storm, and if the volatility continues, then consumer staples will continue to do that.
Okay, so what kind of stocks have been standouts?
Well, interestingly, in the consumer staple sector, it has changed in composition quite a lot. Traditionally, it tended to be much more mature businesses like the Wesfarmers and the Woolworths. But there's a growth component to the sector as well now. You've got the Blackmores, the Treasury Wine Estates, the A2 Milks that are in there, as well as Coca-Cola Amatil, which sits in there as well. So, look, there's
some good growers amongst that too, aren't there?
There is. There's a diverse range in that consumer staples area, and I wouldn't count them all as consumer staples. Some of them very much are geared towards that Asian growth story. So I guess in times of volatility, you'd be going towards the Coles or the Woolworths. And look, we're just in the midst of Christmas spending, and I think the grocery type of supermarkets are going to do quite well. Yeah. So I'm a big fan of Woolworths.
Because when you think about it, I didn't think about Blackmores being in that sector, but if you're a health food junkie, it takes vitamins, you're going to do that no matter what, aren't you? You aren't going to sort of see it as a discretionary spend.
Yeah, I guess in the area of vitamins and health, generally is seen as quite a defensive space. It's a little bit strange for our healthcare sector as well, because healthcare tends to be quite defensive, but in our healthcare sector, we have quite a few growth stocks and growth options.
We certainly do. Okay, let's get down to the ones you really like, and we'll ask Michael and Junbo to either support or criticise you heavily.
No pressure.
That's not possible. So go on, Julia.
Ingham's would be my pick in this space. Okay. Look, it has a really...
You're no chicken, you're going for Ingham's. Yeah?
I'm not a young chicken anymore. But look, in this space, it is hard to... And in fact, in terms of the Australian market, it's hard to find yield with that earnings growth behind it. And Ingham's has a very strong dividend yield. It's 5%. It's now ex-capital return, so we won't count that into the picture. But the dividend is quite strong, and the growth story in terms of poultry is there as well. Now, there is the impact of the drought in there, because as the drought hits, of course, feed becomes more expensive. But the impact of the drought is starting to pass. And of course, all meats have the same type of impact, because whether it's cows or chickens, you still need to have that feed.
But is there a substitution effect if beef becomes more expensive because of the drought? Well, often beef prices come down because of the drought. They pump the supply out there, don't they?
Well, chicken's one of the cheapest sources of protein that you can get. So in terms of price comparisons, as budgets get squeezed, it's probably more of a beneficiary of a squeeze in terms of budgets.
Okay, so that's the number one you like. Michael, what do you think about Ingham's?
I like it. One of the things I noticed about protein sources is the big change we've seen over 50 years. I'm one of 8 kids, Peter, and so we had a lot of
lamb.
one
chicken leg, did you?
Well, we kept chickens in the backyard, and on a special occasion, one would donate itself to the dinner table, and but that's how expensive chickens were back in the day, and yet lamb was. Now you can, I pick up a chicken on my way home, and I need to take out a mortgage to buy a lamb rack. So things have changed a lot, but I do like the Ingham's business. One of the questions I would have around it though is, will they be impacted by? There's a bit of a movement towards ethical eating and some concerns about how our protein is sourced. Do you think that's something that will impact them in the future?
Absolutely, and we've seen that definitely in the egg space. But as we move to ethical eating, that comes with a premium price, which is good news for a large chicken producer like Ingham's. And I guess the egg producers have shown that you can have different ranges of products within the business as well. And I guess the main risk I see to Ingham's is the fact that they do derive 50 to 60% of their revenue from the supermarkets. So that is a major benefit, but it's also a major risk because you are quite dependent on that supermarket.
Junbo, what do you think of Ingham's?
Yeah, I will be quite contrary to what you think. And I think that's the risk I will be concentrating on, is that your large customers is pretty much determining their entire future. And previously the problem is, if Coles was having $9 chicken instead of $10 chicken, and then the flow-on impact on the business, and we all saw the earnings were halved, and created all sorts of problems in terms of sizing of the chickens, and creating all sorts of logistic issues and supply chain issues for the business. So going forward, it is a business that it's more about cost efficiency. There's really not that much revenue upside. There is a volume upside, but then the price will have to come down when that does happen. So to me, it's a tough business. It's all about cost efficiency, and especially now with a new management team. Look, it will take some time for the business to really prove that they could deliver something that is very different, that they can use as a bargaining power with the major customers. Yeah.
Do they have many rivals in the market?
Well, there was a New Zealand business, but it looks like Ingham's has pretty much cemented its dominance here in Australia and moving into New Zealand. And look, they are growing, so they are growing, and we've seen their growth plans recently, and I guess in some ways the share price does reflect that. So the share price is up around about 16% for the year. It's one of those stocks that has been doing relatively well and it's trading near its all-time record highs. But I think it is because income investors are finding it hard to find stable sources of cash flow and dividends in the type of market we're in, where there are a lot of domestic pressures. I mean, we've seen new vehicle sales down for 7 consecutive months now, house prices down for 12 months now, the GDP numbers missed. So the domestic factors are starting to weaken off, and in that type of environment, I would actually put a premium on quite stable cash flows and a strong income.
Junbo, do you have a staple that you like?
I think in the staple space, I do like the Woolworth idea, but I think the Woolworth has rallied very hard. So to me, Coles is probably a better play on that front, just given the discount it's trading to relative to the Woolworth. And of course, Woolworth is going to have a buyback and the like to give back some excess franking credit. But I do think on that front, you know, Coles will probably do a little bit better. Plus, it's just rollout. Again, it's a little shop sort of thing. If you like me, you know, we've got package boxes and boxes of them at home, and it does drive the volume. And if we saw when they first launched it, the like-for-like grew at 4%. Of course, since it has dropped back, so now they've relaunched it again. So probably you're looking at a pretty good growth environment for Coles.
Well, Michael, you know, when you were a young tacker and your mother used to take you to Coles, you know, with the rope.
I was
going to say there is no Coles in Mossman. I didn't realise there were chickens either.
I don't have a vision of all 8 kids being tied by ropes, so she knows where they all are.
We did lose one, I think. Yeah.
But you are a Coles man, aren't you?
Well, in fact, I've got a pairs trade on at the moment. From a trading point of view, I'm long Coles and short Woolworths, and it has to do with the now comparability of the businesses and the fact that they're trading on very different multiples. Right, adjusting on the fly, so don't hang me on these numbers. But after today, Coles will be trading on around 17 times, whereas Woolworths is 20 to 21 times. Yeah. So for me, it's not a view on either. Frankly, I don't generally go for the steadier earnings profiles that you find in the consumer staples sector. But yes, long Coles as a catch-up to Woolworths. Now, that trade means I don't care if they both go up or they both go down. I'm not expressing that view. I'm just saying they'll move closer together in share price, and that's how I'm looking to profit from
Okay, mate, fantastic. Well, after the break, I'm going to bring back my 3 very competitive market analysts, and we're going to look at the stocks that they actually like going forward, given the fact we've lived through a pretty hefty sell-off. Back in a moment. Welcome back to Money Talks, and now we're going to look at the stocks our experts like following the recent sell-off. All right, JB, you go first.
All right, how many do you want?
I think 2 good ones.
All right, 2 good ones.
And be right. I don't want any danger.
All right, okay, they will definitely go higher. Look, the first one, I know you talked about it. So CSL is going to do very well. Yeah. Earnings going to get upgraded, and the multiple has retraced back from the highs it achieved 6 months ago. Yeah. The company is in the leading market position, and its flu businesses will do very well this year as well. The company have visibility of 18 months of double-digit growth, and you know, we can see very good pipeline that's coming through its R&D program. So we think that stock will do very, very well.
Okay, hold that one, and we'll come back to you now, Michael. She's stolen CSL from. I don't like CSL.
Yeah, who doesn't love CSL?
Well, I was looking at that chapter, but look, and don't try this at home. But I bought banks today. I bought ANZ, I bought NAB, and I bought Westpac.
Yeah.
They've got back to prices that I've had, you know, in my spreadsheet for a long time. I know things look bad, but I've learnt lessons over the period. They're at my price, so I've stepped up to the plate. Now, in the sell-off this afternoon, I got hurt. Right? But for the long run, I'm happy to be there. These businesses aren't going away, and the dividend yields at these current share prices are now at levels where I just found it compelling. Yeah.
Well, you are getting older, and dividend yields are pretty good. As long as you don't retire, you still can use the tax credits.
And I was very late. I've been very light on banks. I only held CBA up until today. So.
Yeah, that's a courageous call, Minister. All right, Julia.
Well, I've been moving towards defensive for a number of months now, so I've been concentrating on the defensive space. Yeah. So I guess we've been covering a lot of the sectors week by week. So in the property space, it'd be Dexus, Charter Hall,
did well last week. Didn't Dexus respond well last week?
I think this week as well, we're hitting a new 52-week high. So office is still really strong here in Australia, and Dexus has the largest exposure to Sydney office. And the great thing about office is that those multi-year leases, they start to run off and you get that repricing effect coming through. So look, you're going to see that for the next couple of years. So Dexus looking good in that property space.
Okay, tick on Dexus. Okay, Junbei Liu. JB.
I am actually slightly more bullish the stock market for 2019. So my other call...
not so much in the economy, but you like the stock market?
I think the stock market is
well supported. I like you even more,
I think it's well supported. The bargain, the like, and you know, we can get into another session, another half an hour. But I think Costa Group will do very well in the next 12 to 18 months. The stock has listed in 2015. It's been growing 26% compounded since listing, and is projected to grow between 10 and 15%. Produce produce that is in the superfood category, the largest blueberry producer, and now they produce in Morocco, in China, and it's well leveraged. We can see double-digit growth for the next 5 years. The stock is a great buy.
Okay, when you had eight brothers and sisters, there was no blueberries in your family, were there? Particularly
Chocos.
But the price is like you have to have a credit card just to pick up a
I can't even afford the frozen one.
Okay, so let's go to the
10-cent holdings.
Wow.
China's largest telco.
You're getting so courageous, man. You're a very big tick.
Well, the reason I discovered it is I'm very attracted to Hong Kong stocks at the moment.
Yeah.
I think they're holding a discount that's unjustifiable.
Yeah.
So long term, it's not my first move there, but long term I was looking to increase my exposure, and I've really got plenty of exposure to the banking system in Hong Kong. So I was looking around it, and this is a company with incredible reach, great
Everyone loved it before the Trump trade war, didn't they?
Well, exactly, and it's back down now to around 310 Hong Kong dollars. So for mine, a very easy diversification. I'm a little nervous about the level of the Aussie. I don't think there's a huge amount of downside for the Aussie, but nonetheless, I just found 10-cent compelling on its standalone.
Well, last week when I talked to you, you talked about buying an ETF on the Chinese market. So you guys are getting really close together on your thoughts, aren't you?
Yeah, well, I think the sell-off is quite overdone. And look, the cycles are different. So watching for a turn in the cycle, whereas the US economic cycle looks like it's peaking. For China, we're looking at something different and a bottoming out and stimulus starting to take hold. So if you're looking at the benefits of diversification and you want economic cycles and assets that move differently, well, you know, the US and China are at complete opposite ends of the spectrum.
Have you picked out what ETF you actually would buy?
I would probably look at a Hong Kong exposed ETF rather than the Chinese market, because the Hang Seng does tend to be a little bit more liquid, a bit more transparent, and move a little bit.
You get exposure to 10 cents through that Hong Kong one, wouldn't you?
Yeah, I think if you were particularly interested in 10 cent, you probably go down the technology route, so even away from the FANGs and into more of those technology stocks over in China. But brave call, and you know, Michael's been great at being brave and right.
I've been brave and horribly wrong too. That is what the price
Michael, is there a certain stage of your life that you actually have become even more aggressively gutsy?
I've got more aggressive as I've got older. I realise that's not the path everyone takes, but yes, it matters less, Peter.
Well, we're living
it's a linear world.
We're living so long nowadays, you can't go defensive age 60, even though you're not 60 yet, but still.
Yes, thank you. It's always a pleasure coming on your show.
I love you like a brother, that's why I mistreat you. All right, JB, one last one.
One last one. Actually, now that we're talking about Chinese stock, let's go to this one. The list in the US, it's called the New Oriental. It offers after-school tutoring services in China.
Don't Chinese people love that.
Talk about Tiger Mom, their wealth and life. And what do they love? New Oriental. It's listed in New York Stock Exchange, and the stock has come off given all the volatility in the emerging market in China and the like. But the company has $1 billion of cash on balance sheet. It's been consolidating in the industry, and recent reform encouraging teachers to have more qualification and the like. And we'll see this company taking advantage of the very fragmented industry. The company has market exposure with the top two player only have 3% of the market, and it's so fragmented, and it's growing the double digits. So
okay, that's a good one. Now, before we go, there's not an analyst or expert I know who doesn't think Aristocrat looks like good value. Do you agree?
I have concerns. I think if we're going to see moves in the financial space, it will end with moves in the gambling space. And so longer term, I have some concerns. I've got to say they've been brilliantly successful in their introduction of what's now known as the Australian machine worldwide has really bolstered the company. But they're having a few issues in the US at the moment. They're having a few issues locally, and there is that regulatory risk. I don't think they're a bad company. I just look for a better entry price.
Quickly, Julia, Aristocrat?
Oh, well, I love the stock, but no rush to jump in. We've seen updates coming through from the Las Vegas casinos as well as the Macau's, and they have been relatively soft. So, no rush, but I think it's a good quality company. I like the social gambling side. And for a total specky stock, once again, no rush, because as the market sells off, it'll sell off a lot more. MVP, the green whistle.
Okay, one quick one, JB. Aristocrat?
Oh, I love it. I think 16 times 2019, it's cheap. Take a 12-month view, you'll make your money. And you'll make at least 30% return on that stock. Currently being sold off as people worry about those Macau weakness driven by people who gambles as VIP in Macau, kind of, owns all the import-export business, which is impacted by the trade war. And we sort of think that is not the case for Aristocrat.
So you're saying when Chinese entrepreneurs and businesses feel wealthier, they go gambling?
That's right.
Yeah, great stuff. Interesting point. I think you guys actually know that group better than myself and Michael, that's for sure. Thanks very much. It's a great show. And of course, all these tips will be absolutely right. Even the banks, Michael. What a brilliant call.
Thank you, Peter.
That's it for Money Talk tonight. Next week, we'll see if Donald Trump will help or hinder a Santa Claus rally. And if you want daily updates, just go to switzer.com.au. I'm Peter Switzer. Thanks for watching. I'll see you next week.
This program proudly brought to you by IPO Wealth for the sophisticated investor.